Hello everyone and welcome back to another episode of MonsterInvest. I'm your host, Daniel. I want to start today's episode by asking you a question. It's a simple question, but the answer might reveal more about your financial future than any balance sheet ever could. Here is the question: when you think of a master investor, what image comes to your mind? Take a moment, close your eyes if you need to. Do you see a man in a sharp $3,000 suit, standing on the chaotic floor of the New York Stock Exchange, shouting orders into a phone? Do you see a genius mathematician sitting in a dark room, surrounded by 6 glowing monitors, watching charts twitch and move in real time, looking for that one secret pattern that no one else sees? Maybe you imagine scenes from movies like The Wolf of Wall Street or The Big Short. You imagine adrenaline, you imagine shouting, you imagine high stakes, you imagine a world where the smartest, the fastest, and the most ruthless people win and everyone else loses. We have been conditioned by Hollywood, by the financial news media, and by society itself to believe a specific narrative. We start to believe that investing is a battle of wits. We believe that to make money in the market, you have to be doing something constantly. You need to find the needle in the haystack. You need to pick the next Amazon, the next Tesla, or the next Bitcoin before your neighbor does. We believe that if we work harder, if we research longer, if we stare at the screen more intensely, we will make more money. And this, my friends, is the single biggest lie you have ever been told about investing. The lie is that complexity equals profit. The lie is that investing is supposed to be exciting. The lie is that you need to be smart in a traditional sense to be rich. Today, over the next 20 minutes, I'm going to dismantle this lie piece by piece. I'm going to show you why doing less is actually the secret to making more. And I'm going to tell you a story about 2 investors that will change the way you look at your money forever. But before we get to the story, we need to understand why this lie exists. Why does everyone want you to believe that investing is hard? The answer is simple: incentives. Think about the financial industry. It is a massive machine. Brokers, fund managers, financial news networks, trading apps, they all need one thing from you. They don't necessarily need you to make money. They need you to act. If you buy a stock and hold it for 30 years, your broker makes a commission once. If you trade that stock every week, they make a commission every week. If you buy a simple index fund and go to sleep, you don't need to watch the financial news channel. You don't need to click on the article titled 5 Stocks to Buy Before the Market Crashes. You don't need to subscribe to the expensive newsletter. The entire industry is built on selling you complexity. They sell you the idea that the market is a dragon that needs to be slain, and they are the only ones with the sword. They need you to be anxious. They need you to feel like you are missing out. Because when you are anxious, you trade, and when you trade, they get paid. Now I want to introduce you to 2 characters. They are fictional, but I guarantee you know them in real life. Let's call them Action Alex and Boring Ben. Let's start with Action Alex. Alex is a smart guy. He has a good job, maybe he's an engineer or a doctor. He's ambitious. He trusts his own intelligence. Alex decides he wants to start investing. So what does he do? He treats investing like a second job. He wakes up at 6:00 a.m. to check the markets in Asia and Europe. He reads the Wall Street Journal. He subscribes to 3 different stock picking services. He downloads a trading app on his phone that has flashing red and green lights. Alex believes the lie. He believes that he can beat the market. It's 2010. Alex has $10,000 to invest. He spends weeks researching. He looks at PE ratios. He looks at candlestick charts. He finds a tech company that just released a revolutionary new product. He feels a rush of excitement. He presses buy. For the first week, the stock goes up 5%. Alex feels like a genius. He tells his friends at dinner, "I really understand the tech sector, you have to see the trends." But then 2 weeks later, the CEO of that company tweets something controversial. The stock drops 15% in one day. Alex panics, his heart races. He reads the forums and everyone is screaming, "Sell, sell," so he sells. He takes a loss. He tells himself, "Okay, that was a bad pick. I need to be safer." So he moves his money into gold because he read an article about inflation. Then gold stays flat for 6 months. He gets bored. He sees his friend making money in cryptocurrency. He feels that pang of jealousy, FOMO, the fear of missing out. So he sells the gold and buys the crypto at an all-time high. Alex is constantly moving. He is a goalkeeper who feels like he has to dive to save the ball. There is a fascinating study in professional soccer about penalty kicks. Statistics show that if a goalkeeper stays in the center of the goal, he has a 33% chance of stopping the penalty. But if he dives left or right, his chances drop significantly. So why do goalkeepers almost always dive? Because of action bias. If they stand still and the ball goes in, they look stupid. They look like they didn't try. But if they dive and miss, at least they did something. Alex is that goalkeeper. He is diving left and right, paying trading fees, paying short-term taxes, and stressing himself out because he feels that doing nothing is lazy. Now let's look at boring Ben. Ben is boring. He's a graphic designer. He doesn't know what a balance sheet is. He thinks a candlestick is something you put on a dining table. He doesn't have a trading app on his phone. In 2010, Ben also has $10,000. He reads one book, maybe it was The Little Book of Common Sense Investing by John Bogle. He learns one concept: you don't need to find the needle, you just need to buy the haystack. So Ben takes his $10,000 and buys a low-cost, total stock market index fund. He literally buys a tiny piece of every major company in the economy. And then he sets up an automatic transfer. $500 from his paycheck every single month goes into that fund. Automatically, he doesn't even see the money. And then he does absolutely nothing. He goes to work, he spends time with his family, he plays video games, he learns how to cook. Let's fast forward to a crisis. Let's say it's a major market crash like what we saw in 2020. The market drops 30% in a month. The news is screaming Armageddon, the end of capitalism. Action Alex is glued to his screen. He is sweating. He sees his portfolio down 30%. He thinks, I need to stop the bleeding. I need to sell now and buy back in when it's cheaper. He sells everything at the bottom, locking in his losses. He feels a sense of relief that he is safe in cash. Boring Ben doesn't even know the market crashed. Why? Because he forgot his password to his brokerage account 3 years ago. He is too busy watching Netflix. His automatic transfer of $500 still happens. In fact, because the market is down, his $500 is buying more shares than usual. He is buying stocks on sale, and he doesn't even know it. A few months later, the market recovers. Action Alex is still sitting in cash, waiting for the right moment to get back in. He watches the market go up and up and up. He is paralyzed. He missed the recovery. Boring Ben is still just existing. His portfolio recovered and then grew even more. Now let's fast forward to today, 15 years later. Action Alex is exhausted. He has gray hair from the stress. After years of buying high, selling low, chasing trends, and paying thousands in fees, his portfolio has grown, sure, but barely enough to beat inflation. He has some cool stories about that one time he made 50% on a trade, but his net worth doesn't reflect the effort he put in. Boring Ben finally finds his password and logs in. He is shocked. His money has compounded into a small fortune. He didn't just beat Alex, he crushed him. This isn't just a fable. This is backed by hard data. Let me tell you about one of the most famous bets in financial history. The year was 2007. The legendary investor Warren Buffett made a public bet. He bet $1 million that a simple, boring S&P 500 index fund would outperform a basket of the best, most exclusive, high-fee hedge funds over a 10-year period. Now think about this. Hedge funds are run by the Action Alexes of the world on steroids. These are the smartest people in the room. They have algorithms, insider connections, and teams of analysts. They charge massive fees because they claim they can beat the market. The bet began in 2008, right before the massive financial crisis. It was the perfect time for active managers to shine. It was a chaotic market. 10 years later, in 2017, the results were in. The hedge funds, the smart money, delivered an average return of roughly 36% over 10 years. The boring, simple index fund, it delivered a return of 126%. The boring strategy didn't just win, it destroyed the experts. It wasn't even close. Buffett won the bet and the proceeds went to charity. Why did this happen? It happened because of costs, and it happened because of human error. Every time you try to outsmart the market, you are competing against millions of other people trying to do the same thing. It is a zero-sum game. For you to beat the market, someone else has to lose. But when you buy the index, when you buy the whole market, you are no longer a hunter. You are a gardener. Action Alex is a hunter. He goes out into the jungle every day with a spear, trying to kill a big animal. Some days he eats a feast, some days he starves. It is dangerous, tiring, and inconsistent. Boring Ben is a gardener. He plants seeds. He waters them. He ensures they have sunlight. And then he waits. He doesn't dig up the seeds every day to check if they are growing. That would kill the plant. He trusts the process. He trusts the seasons. The market is a farm, not a casino. But here is the hard part. Here is why so many of you listening right now will struggle with this advice. Being boring is hard. Our brains are wired for dopamine. We are wired to seek rewards. When you buy a stock and it goes up, you get a hit of dopamine. It feels good. It feels like gambling. When you buy an index fund, nothing happens. It's like watching paint dry. It's like watching grass grow. It is painfully unexciting. George Soros, a man who broke the Bank of England, once said, "If investing is entertaining, if you're having fun, you're probably not making any money. good investing is boring. If you're looking for excitement, take $200 and go to a casino, go to Las Vegas, have a drink, yell at the roulette wheel, high-five your friends. That is entertainment, that is fun. But do not confuse your entertainment with your financial future. Your life savings, your retirement fund, your children's college fund, this is not money for playing. This is money for growing. So what is the actionable advice here? What should you actually do after listening to this podcast? First, embrace the boredom. Stop looking for the next big thing. Stop trying to time the market. You cannot predict the future, and neither can the experts on TV. Second, automate your discipline. You are human. You are emotional. You will panic when the market crashes, and you will get greedy when the market soars. The only way to protect yourself from yourself is to remove the decision-making process. Set up automatic transfers. Delete the trading apps from your phone. Make it hard for you to interfere with the process. Third, extend your time horizon. If you are investing for next month, you are gambling. If you are investing for next year, you are speculating. If you are investing for the next 20 years, you are building wealth. Compound interest needs time. It is a slow curve at the beginning, but it becomes a rocket ship at the end. But it only works if you don't interrupt it. Imagine a snowball rolling down a hill. At the top of the hill, the snowball is small. It rolls slowly. It picks up a little bit of snow, but as it keeps rolling, it gets bigger. And because it's bigger, it picks up more snow with every rotation. By the time it reaches the bottom of the hill, it is an avalanche. Action Alex keeps stopping the snowball to check if it's round enough. He keeps moving it to a different hill. He never lets the momentum take over. Boring Ben just lets it roll. I want you to be Ben. I want you to be the boring investor. I want you to be the one who retires wealthy, not the one who has exciting stories about how much money they almost made. Let the market do the heavy lifting for you. The companies in the S&P 500, Apple, Microsoft, Google, they have thousands of employees working 60 hours a week to make their company profitable. They are working for you. Let them work. You don't need to work. You just need to hold the shares. So as we bring this episode to a close, let's summarize the lessons from today. If you were taking notes, here are the 3 things you need to write down. Point number 1, complexity is a sales tactic. The financial industry sells you complexity because it generates fees for them. You do not need complex strategies to build wealth. Simple often beats complex. Point number 2, your behavior matters more than your intelligence. It doesn't matter how high your IQ is. If you cannot control your emotions, you will lose money. The biggest risk to your portfolio is looking back at you in the mirror. Point number 3, boring is the goal. If your investing feels like a roller coaster, you're doing it wrong. Real investing should be dull, consistent, and disciplined. Don't let the noise distract you. Don't let the fear of missing out turn you into Action Alex. Be the gardener. Be the goalkeeper who stands his ground. Be boring. And one day, when you are looking at a portfolio that has grown beyond your wildest dreams, you will realize that the biggest lie was thinking you had to be a genius to get there. That's it for today's deep dive on MonsterInvest. I hope this episode gives you the permission to relax, to step back, and to let your money work for you. If you found value in this story, please share it with a friend who is stressing out about the stock market right now. They probably need to hear this. I'm Daniel, thank you for listening. Keep investing, stay boring, and I'll see you in the next episode.